Okay, we're going to get started. Good afternoon, everyone. I'm Sarah Lefton. I'm the Chief Development Officer at UJA. First, thank you so much for taking the time to join the Jewish Foundation of Greater Toronto's Market and Investment Outlook webinar for 2024. We really appreciate you taking the time to join us today. We know everyone is busy, but we're hoping that we can share some very important information with you about how we were doing this past year, what our impact has been, and also we'll have some time for questions. Throughout the webinar, we encourage you to submit questions first through the Q&A function at the bottom of the screen. We'll do our best to answer as many questions as we can. And if we don't have time to answer, please email the foundation at jewishfoundation@ujafed.org, and we can share that in the chat as well for anyone who needs that email address. For today's agenda, I will quickly review the Jewish Foundation's financial highlights for fiscal 2023. We'll then hear from Diana Avigdor, the chair of our Investment Advisory Committee. And then we'll hear from Texas Hemiplard, who's a partner at Mercer, who's going to share details on the performance of our portfolio and market observations going into 2024, along with our investment priorities for this year. And again, we're happy to take questions throughout. I'll start just by sharing that fiscal 2023 was a fantastic year for the Jewish Foundation. Thanks in large part to a careful and effective investment strategy, the foundation had an incredible investment return this past year of 11.8%. Beyond that, we had more than $111 million in contributions, bringing us to more than $772 million in assets under management. We also had more than $51.7 million of impact through grant distributions, truly an incredible number going out to the community. This $51.7 million went to more than 650 organizations, projects, and programs, including, of the $51.7 million, almost $40 million to Jewish causes. Truly, truly remarkable. We know that it's a top priority for the Jewish Foundation to ensure that philanthropic dollars are going to meet the highest priority needs in the Jewish community. And so while we've seen so many urgent needs this past year, and we know we're starting to see them again for obvious reasons in the state of the world in 2024, it is truly incredible to see so many fund holders stepping up to provide this kind of urgent assistance and to make strategic distributions to meet these urgent needs in the Jewish community. So thank you to all of you for doing that and for really recognizing how much some of these organizations and important causes need your help, need our help at this moment in time. I should also note that while UJA's emergency campaign for the people of Israel was not technically part of fiscal 2023, I have to mention the incredible way that fund holders have stepped up to distribute towards that special appeal. We know that that campaign has raised more than $72 million at this point, which is beyond remarkable, $72 million in just over 12 weeks. But as of last week, more than $9 million has gone from the foundation directly to help organizations on the ground in Israel. We've been sending out regularly the breakdown of these allocations to date and recognizing that of the money that's going to the emergency campaign, this is going to be spent over time, meeting the immediate needs at the moment, but also looking at how we can assist these Israeli organizations with the rebuild in Israel of some of these kibbutzim, and frankly, some of the immense mental health challenges that they are facing coming out and during and hopefully coming out of this war. One other note on this, I think many of you know one of the greatest benefits of investing with the Jewish Foundation is the expertise that you will receive in advising on Jewish philanthropy in particular. Fund holders have access to data and research on the highest priority needs in the Jewish community. So I want to urge you going into this next year, if there's something that you are particularly concerned with in the Jewish community, if there's an area that really speaks to you or that you want to learn more about, please know that your advisor at the Jewish Foundation, your point of contact at the Jewish Foundation can help and really provide you with that best-in-class research to help guide your philanthropic choices. And that's not just within UJA, but within the Jewish community generally. So please don't hesitate to reach out. I'm now going to shift gears and introduce the Jewish Foundation's new co-chairs. We are thrilled to have Jack Freiberg and Mike Diamond on board, who have just taken over as co-chairs of the Jewish Foundation. Jack is the co-founder of the WTF Group, an owner-operated commercial real estate redevelopment firm in Toronto. The son of Holocaust survivors who taught him all about community involvement and Jewish continuity. And Jack has been volunteering for the Jewish community for many, many years. I've had the privilege of working with him in the past, and I'm just thrilled that he stepped into this important role of co-chairing the Jewish Foundation. Mike Diamond is a business consultant, entrepreneur, and investor, as well as an active philanthropist. Mike was the president and CEO of Minicom Data Corporation, which was one of Canada's fastest growing software companies. After the company was sold in 1995, Mike evolved into his current role as advisor, mentor, board member, investor, philanthropist, and volunteer. Mike has also been involved with the Jewish community for many years, most recently on UJ's Committee for Countering Anti-Semitism and Hate. We have two incredible and generous people as co-chairs for the Jewish Foundation. I am very excited to be working with them both. I know they will make an amazing impact during their time in these roles, and I really look forward to hearing from them and to continuing our work with them. So Jack, over to you. Thanks so much.
Thank you, Sarah. My name is Jack Freiberg, as Sarah said. I'm truly honored and humbled to be co-chairing the Jewish Foundation for the next 2 years. As I recently took on this position of co-chair of the foundation from being vice chair for the previous 2 years, I began to ponder the concept of why it's called a foundation and why it's so important. I come from at least 3 generations that I know of carpenters and builders. My grandfather was a carpenter in Galicia, Poland in the early 1900s. His 4 sons, when they became teenagers, all worked with my Zaidi in his woodworking shop. Then World War II broke out. 4 of the 5 of them survived the camps by taking advantage of their skills that were needed by the Nazis. After the war in the DP camp, they once again set up a family carpentry shop, and then a few years later, they all moved to Israel in 1948 and 1949, and again set up a shop in Ramat Gan just north of Tel Aviv. In 1953, my father moved from Israel to Toronto with $10 in his pocket and a hammer and started to work as a carpenter. Very soon after, he bought a piece of land, built a small house, then 2 houses, then a 4-plex, then a small building. And at one point in the 1960s, early 1960s, he built a 22-story apartment building in Parkdale, the tallest apartment building in the city. And at the time, and then went on to build all around the province. You can't build a 22-story building unless you have a very strong foundation. All the weight rests on that solid foundation. I came straight out of university and began to work for my father. And then a few years later, exactly 40 years ago, I went on my own in the same industry. You might be thinking of why I'm telling you all this. It's because as a builder, which is in my DNA for generations, I'm acutely aware of the importance of having a structurally strong and solid foundation. You can't build anything that will last without one. It's exactly because of this that our Jewish Community Foundation, which was founded over 100 years ago, has lasted and thrived. As co-chairs, Michael Diamond and myself have an acute awareness of the responsibility that has been bestowed upon us to keep the foundation of the Toronto Jewish Foundation strong, solid, growing, vibrant, and relevant for the benefit for all of you, our stakeholders, and for the Jewish community. We all need a strong foundation, and the foundation needs supportive stakeholders like yourselves. I'm very excited to continue working with the incredibly committed foundation staff to assure steady and solid growth in the foundation. As I just recently sat in on my first investment advisory committee meeting, I was extremely impressed on their investment acumen and dedication to ensure the optimal mix of protection and growth for you, our fund holders, and therefore your charitable dollars. The committee is led by the knowledgeable and experienced Diana Avigdor. Her committee behind the scenes puts so much work and thought into providing safe and steady returns for all of us. On behalf of everyone, I wish to take this opportunity to thank you, Diana, and your committee for all your efforts. I also want to address the announcement we made in December newsletter that in the next 6 months, we will be launching a new software system in our efforts to continually improve how we serve and communicate with you, our fund holders. This will enhance your experience. It includes tax receipts that will be issued via email, grant recommendation confirmations will also be sent through email instead of DocuSign, and a donor portal is in progress, which will provide a lot of helpful functionality to common fund activity. Stay tuned for more information on this in the coming months. Mike and I are thrilled for all the exciting changes coming to the foundation this year. And now I'm not only honored to introduce my fellow co-chair, Mike Diamond, but I'm also thrilled to partner with him for the next 2 years. Mike?
Thanks, Jack. That was terrific. I've been involved in pretty well every aspect of Federation life for a number of decades. And I've watched the foundation during that time grow, and I've learned to appreciate the opportunity, in this case, to be a client or donor to the foundation, just as you are. So I don't come at this as a long-time foundation trustee. I've been kind of parachuted in from the outside, but I've had this fabulous positive experience as a client to carry with me. I decided to agree to co-chair for a number of reasons. First of all, people are key. Working with Sarah Lefton and Brian Arlen, and as well as Jack, who's also a friend, is exciting. These are smart, committed, hardworking people, and we're going to do a lot more to take the foundation that much further forward with many improvements, some of which Jack has just described to you. Secondly, from a community perspective, the foundation is a hidden gem. We've done a lot with it. There's a lot more that can be done in terms of growth and size and scope and utility to the community as a whole and to you, the donors. In the last few years, we've seen the foundation mature greatly in its capabilities, and there's much more that can be done to make it even stronger. Buoyed by consistently strong returns, thanks to a terrific advisory group and a professional staff that is committed to us, the fund holders, we should be proud of what we have built for this community. Third, the foundation is key to the community's future. As Jack has talked about, it's the foundation. My wife and I have endowed a portion of our fund to UJA in order to be part of a movement to ensure that UJA remains strong for future generations. And we've woven the foundation into our wills and trusts to ensure that the next generation is appreciative of the opportunity to give to this community. Finally, I think the foundation can offer its clients so much more in giving opportunities that generate the kind of personal returns you deserve for your donation dollars, finding that sweet spot that makes you smile as you offer your dollars for various causes. Of course, none of this would be possible without a highly functioning foundation with an investment process that works well and can be relied on, something that we have. So with that, let's get to today's webinar. I'm pleased to introduce the chair of the Jewish Foundation's Investment Advisory Committee, Diana Avigdor. Diana is a CFA chart holder, the VP Portfolio Manager and Head of Trading at Barometer Capital, and has almost 3 decades of experience in various asset classes. Take it away, Diana.
Thank you very much, Mike and Jack. I look forward to working with both of you. And I also want to say a few words as a thank you to the foundation. I found that working with you has been absolutely wonderful, and a special thanks to my wonderful committee of professionals that spend a lot of time and energy and interest and motivation in doing this work. And finally, I just want to say that I appreciate everyone's time for joining this annual review, and we appreciate you and all you are to the Jewish community. These are challenging times in our history, again. So we therefore need to be strong and financially healthy. I'd like to spend just a few minutes with commentary on what is going on in the world. It's going to be a top-down macro view and what it means for how we view the Jewish Foundation investments before we go into a more granular situation. We have an investment objectives. I just want to go through some of the fiduciary stuff first. Investment objectives. The foundation has an investment policy that's available to everyone. And in that policy, we lay out our investment objectives. There are 4 components. Earning enough to offset the annual distribution rate from the portfolio, keeping up with inflation, which has been somewhat challenging of late, given how quickly and how fast inflation has rallied up, outperforming the costs of managing our portfolio, which are not that high, and building a reserve to grow the portfolio for the future generations of our community. These objectives ground what we do to invest the foundation's portfolio. In terms of governance of the Jewish Foundation, that has also 4 key layers. We lay out the roles and responsibilities on this page, and it's a page many of you have seen before. On the far right side of the page, we detail our committee. There's 11 investment professionals. They're all working in various areas of the capital markets, investment world, real estate. They're all volunteers. We meet at least quarterly to monitor the portfolio and markets and set the long-term direction for the portfolio and adjust that direction as needed. Okay, so let's begin. I just want to talk a little bit about how we think about the world these days. And I have 10 pictures to share with you quickly, nicer than just looking at me when I speak, for about 10 minutes. Then we will delve into the portfolios more surgically with our extremely capable long-term consultant, Texas Hemaplat. So Warren Buffett said in his latest meeting, investing is like dieting, simple, but not easy. Everyone knows what they should do, buy low, sell high, but markets are very tricky. In the next slide, I want to share with you the challenge. The issue is that the information we are investing on is usually unclear at best and has lots of complexities and moving parts. The correlations are complicated and unstable. Everything we think, read, and learn is either a fact, a possibility, or a probability. The problem with that is that those three are interchangeably confused by the professionals we talk to, ourselves, and the constant media analysis. What might sound like a fact is actually just a possibility, and vice versa. There is a big debate on inflation and rates and recession views, and that affects portfolios. This brings us to what those who know me is often my theme and was my soft theme last year, that predictions are tricky. My other theme was that down markets are an opportunity for long-term investors, and this year's performance made up for a little bit of softness the year before. We had funds that were invested. We always get cash flows. Funds are invested at lower prices, and markets generally do go up over time. Regarding predictions, there is a saying, if you're going to forecast, forecast often. That way you may end up being right someday. Wall Street got it famously wrong in 2022 and 2023, both in stocks and in bonds. So with your permission, I will not forecast. Mercer does long-term return analysis, which we consider in our long-term allocation strategies, but it is so much more than just a forecast. Their long-term calculations allow us to be more surgical about where we want to lean into, like, for example, private credit or exposure to real assets to help protect against longer-term potential inflation. I want to share with you some things that markets are watching over the short term. We will, however, always think of our portfolio in terms of, is it well diversified rather than predicting it? Are there any hidden risks, any unintended overweights or unknown exposures? Is it navigating well for the long term? Are we paying the right price for what we invest in? The most talked about thing nowadays is whether we have a recession. And if so, is it going to be long or short and shallow? This one has gone through all the stages of facts, possibilities, probabilities. In 22, it was a fact. Then in 23, a probability, and now a possibility. 23 was a remarkable change of mood. Recall the pessimism this time a year ago. For example, 58% of respondents to Bank of Canada's quarterly business outlook survey in autumn of 22 said the odds of a recession over the next 12 months were at least 50%. A quarter of respondents put the likelihood of a downturn at between 80 to 100%. Predictions didn't happen yet. Indeed, demand slowed in 23, but it didn't crater. The economy added almost 500,000 jobs in 23. Who would have thought that employment was going to be so strong? No one expected this. If markets are a forward-looking pricing mechanism, then as we head into 24, the question of whether we will get a soft landing has been answered. After a very difficult 22, 23 negated that fact and repriced for a soft landing. Talking about forward-looking pricing mechanisms, recessions have been very rarely well telegraphed. Alexis, can we have the next slide, please? The housing bubble of 2007 and 8 didn't happen because everyone expected it. The 22 sell-off didn't happen because everyone expected it. As a matter of fact, Fed Chair Powell, in the beginning of 22, put rate expectations at less than 1%. He ended up taking rates to over 4%. The tech bust of 2000 also didn't happen because everyone expected it. So predicting isn't all that is made to be. As a matter of fact, I mentioned in my webcast last year, the market in 22 ended 25% below most analysts' forecasts, and they got it wrong for 23 as well. So a recession is the one thing that forward-looking markets do not do a good job of. Looking at this picture in front of us, we can see that most of the sell-off happens when the recession happens, and not very much before at all. So it doesn't pay to trade ahead of that anyway. No amount of predicting would help the fact that you could not make money trading that event ahead. I mean, you could sell and wait, but you could be giving up a lot of upside doing that. And then who knows, the prediction might not even materialize because, well, that's how predictions are. So we talked about the possibility of recession. What about inflation? And we have the next chart, Texas. Goldman titled their 24 outlook as "We landed. Now where's the taxi?" Now what? Inflation moderated, rates are higher. Is it different this time? Is a pandemic a regular event, I ask? Soft landings are hard to achieve, but not impossible. While inflation is still above the level of 2%, which by the way is an arbitrary number, you can say 3% is the right level. The nosebleed levels of inflation and supply bottlenecks post-COVID have subsided. Purple is good, yellow is services, orange is energy, and blue is food. Taking you back to 2021, we saw this huge growth in inflation at all levels. This was the coming out of COVID. This, of course, was the trigger. Now things are getting better on all metrics. Only services are still high. Hopefully, what is happening in the Red Sea doesn't work to increase the supply chain bottlenecks again. The fact that commodities are not rallying on heightened geopolitical events is a head scratcher, but then again, China is on its hind legs. Another important point that plays into this is that 2023 brought a lot of flow into money markets. There's $6 trillion in money market at 5%, a higher yield that was seen in decades. That on its own can be inflationary, means people have money and they will spend it. Make no mistake, I think this is fantastic. This is what will keep the economy growing and contribute to the possibility of soft landing. So how is the very important 75% of GDP contributor, consumer, doing? In the next chart, we can see what the consumer did during Thanksgiving, and I can tell you that Christmas season was as good. The consumer has stayed very strong. Strategas Economist, a major Washington think tank, said this: you only need to ask 3 questions. 1, do you have a job? 2, do you expect to keep your job? And 3, if you lose your job, do you think you'll find another one? If the answer to all 3 is yes, the economy is in good shape, and the world in the largest shopping mall, the US of A, has been shopping, keeping the hard landing at bay. Black Friday and Cyber Monday results were way over expectations. Again, with those expectations. If we can go to the next chart, we can see that this is a misery index. This is unemployment rate plus inflation. And the misery index, as long as there's jobs, people have employment, the misery is low, and there's no stress in the system. So what do strategists say? The next chart shows you the big lack of consensus. On balance, people are pretty bearish. There are over $6 trillion in money market, like I mentioned. There's this old saying, markets will do what hurts most people most. And for the market to do that now, with all that cash on the sidelines, it has to rally. According to CNBC's tracker of S&P 500 year-end targets, not even one is expecting a double-digit percentage gain in 24. Can we have 11%, please? And going forward in the next chart, if the market is a capital producing exchange, then earnings are what matter. And this is the 23, 24, and 25 earnings progression expectations based on company guidance and other metrics. These are not facts, but probabilities for sure, as long as people keep their jobs. And finally, I want to leave you with 2 key points that we keep in mind all the time and manage for. This is simple math, and for me is the only thing I need to see in order to convince me that it is not about blowing the lights out with that huge home run, but about proper diversification and risk-adjusted return that is more important than pure return. They call it stairs up, elevator down. Means that it is hard to make it, easier to lose it, and very hard to make it back. It means that we do everything we can in the portfolios to minimize the drawdown and smooth out volatility, because it takes more than the drawdown percentage to make it back. When you look at extreme, if you look at the extremely bottom bar, if you lose 90% of your capital, you need to make back 900% to come back to even. If you lose 50% of your capital, you have to make back 100% to make it back to even. So we do everything we can to have low and small drawdowns that are easier to recover from. And then the final chart that I want to show you is something I used in the webcast last year. It highlights very well the value of long-term holding, which is what a foundation like us have. Make no mistake, when your time horizon is forever and beyond, if you manage for minimal drawdown and good diversification, it will be hard for the returns to not be positive over time. You won't blow the lights out, but you will also not blow up, and you will have created a situation and a return that answers to your objectives, which I outlined in the beginning. And that's it for me. Thank you for listening. I will now give it over to Mercer. With this backdrop, I'd like to introduce our senior consultant, Texas, coming to us from New York. Texas leads his team, and he has worked with us for over a decade. He has over 26 years of experience working on investments for foundations like ours, both across the US and in Canada. Texas will take us through how we have performed, risks and opportunities in markets as we begin the year, and our foundation's investment strategies. Texas, over to you. Thank you.
Thank you very much, Diana. Thank you all for joining us today. I think I have the pleasure and the honor here of taking us through this last section of today's presentation before the Q&A, and then there'll be a bit of an investments review that I'll do here, a little bit of markets outlook and what that means. But just as a reminder on the Q&A is open. You can click on the Q&A icon for Zoom and type your question in there. We'll see it, and we'll get to that. We'll get to answer as many questions as we possibly can toward the end here. I think as we go forward here, maybe just a level set for those of you who may not know my firm, Mercer. Our team at Mercer works with over 300 mission-driven endowment and foundation and not-for-profit hospital and healthcare clients. We're really proud to have served these clients for over 46 years, and with the Jewish Foundation here for over a decade. So this is wonderful work. It's been wonderful to see the growth and development here of the portfolio and of the overall foundation. Okay. To get into investments a little bit here, the most important decision that affects long-term investment outcomes is what the investment world calls asset allocation, or that's really how much to allocate to which main types of investments. Because it's so important, we may spend a little more time on this page than any other that I've got to present this afternoon. The subtitle that you see underneath the title there up at the top of the page summarizes the strategy in words. It's an endowment approach with global diversification. So first things first, that endowment approach, as Diana pointed out, this is a very long-term portfolio. It's really intended to be an endowment, to endow the community, provide that foundation for the community's stability and growth into the future. And what that means is that it's in perpetuity. It's a very, very long time horizon. And that means the investments ought to be aligned with that approach. And then the global diversification just means diversifying the investments, including Canada, but then also looking around the world where it makes sense, primarily actually looking outside of Canada to really help diversify the risks of investments in any one country or even one asset class or one sector. So, I think in words, endowment approach, global diversification. Now, the pie chart on the left-hand side that you see here is the long-term strategy. So I'm actually going to walk through all of the pieces of the pie chart. There's not too many of them. Starting at the 12 o'clock and then moving clockwise, you'll see a number of blue pieces of the pie. These are what we'd call growth assets, the parts of the portfolio that are intended to propel toward growth when markets go up and when economies are on the upswing here. And you'll see they're all blue. There's different components. There's a Canadian equity piece at 10%, global equities at 30%. So you combine that with Canada, and we've got about 40% of stocks. Private markets at 25%, liquid real assets at 5%. And then you see as on the right-hand side there, we summarize all these in the dark blue, and that's 70% of the assets. So this is a 70% growth-oriented type of portfolio. Now, markets zig and zag a lot, and so to help to control some of that risk that, Diana, you talked about of diversification and helping to protect on the downside, that's what those gray parts of the pie are really showing here. The risk-reducing hedge funds at 15% and fixed income that is almost entirely Canadian bonds, mostly investment-grade bonds, at another 15%. So 30% of the portfolio that's intended to sort of protect more on the downside when there is when the market does decide to go on the downturn, which is inevitable. Now, this pie chart on the left is long-term strategy. And what we thought we would do, which we haven't done in past years, but in this year, really to show how the foundation is actually invested. So on the far right-hand side, you'll see a column of numbers, and that's asset allocation. And we're showing this as of the end of September. You'll see that we've got some December numbers that we're going through reconciliation to tick and tie all of the numbers here through December. But through September is a decent, and December won't have been that different. But what you see is, first of all, that 51%. That's 51% to public equities. And as you look toward the left, that's a little more than the overall strategy target of 40%. And then the next line down, 14% in private markets. That's a little lower than that as you look toward the left, the 25% target there. And what this is representing is a shift from the public markets into the private markets that is in process. It's a multi-year process. It's very deliberate to do this over time and to adopt those and to invest in those private assets over time to help with the diversification and not to put all the eggs in one year's basket for private investments. Now, we expect this gap between the actual and the targets to close. It's going to close relatively slowly, but not so slowly. We're talking about a few years here as we look ahead. But we want to be deliberate because as cash for these investments are put to work, that requires a lot of work by the investment advisory committee, and that's paced into the quarterly cycle of work that the investment committee does. Okay, so this is the overall strategy. You should be asking, what have the results been? And this is this next page here. We are also, unlike past years, we're including different comparative information here to maybe show you a couple of different ways that we can compare the performance versus some other benchmarks. But let me just orient everyone here, first of all. So the bars on the page are showing total return performance. So that's dividends, income, and all gains, realized and unrealized gains, just what we call total return. Each set of bars, so there's sets of 3 bars, each set of bars is a time period. On the far left-hand side, 1 year, and then you see as you go toward the right longer term, all the way out to 10 years, and we even show a 22.25 years out on the far right-hand side. And then of the set of 3 bars, the first dark blue bar is the performance of the foundation's investments. The second bar, the middle of the 3, I might call it a bluish green, is the performance of 70-30, so 70% global stocks, 30% Canadian bonds, which overall represents the overall performance or the overall asset allocation structure of the foundation's asset allocation. And then the third bar of the sets of 3 is that 70-30, but we're showing 70% Canadian stocks, 30% Canadian bonds overall. So maybe to just put this in context, on the far left-hand side, you'll see the bars. Now, this is the past calendar year, 2023. Again, we're still ticking and tying all the numbers, so it might move around very slightly, but this is a decent estimate through the end of December here. Calendar year performance up 10.4%. That absolute return of 10.4% is phenomenal. As we note down underneath that, the U.S. equities were the best place to be. So really, in hindsight, we should have just allocated everything to the U.S. But of course, from a diversification perspective, that makes no sense. And so what we're looking for is consistency overall. And what you see is that that 10.4 is in line with the 70-30 benchmark of Canadian stocks and bonds. And as I'll get into a little bit later, we're accomplishing that with a whole lot less risk, which doesn't come into play here, at least not on this particular chart. And then you'll look over to the 5 years, because Diana, I think as you've pointed out, this is a very long-term portfolio. We should be looking at long-term results, but in my mind, the long-term is made up of a lot of short terms, and maybe 1 year is too short, but 5 years actually makes a lot of sense and really illustrates a lot of what we're talking about with this global diversification. The past 5 years, that's 7.7% annualized return. So just to be clear, that's not 7.7%, it's 7.7% per year, annualized and compounded. So the total return over 5 years isn't 7.7 times 5, which is 38, but because of compounding, it's 7.7 compounded over 5 years, which is actually 45%. So over the past 5 years, the foundation's investment return has been a whopping 45%, which is really terrific. Now, as you'll see in the bars, that 7.7 is pretty close to a 70-30 benchmark of global stocks or Canadian stocks and bonds, 8.8 and 8.3. What we're not showing in this chart is dramatically lower risk in the portfolio And we start to point some of that out in the bullet points here. The overall foundation's portfolio has had less than 50%, so less than half of the risk of Canadian stocks and less than 40% of the risk of global stocks. So that really speaks to the diversification benefit that we're getting here from allocating according to all those different asset classes that I showed on the previous page. And I hope reinforces the message that Diana, I think you were delivering here about the overall strategy, which is consistency and some protection on the downside. We want to participate in the upside. We don't necessarily need to be 100% participation on the upside, but we really want to protect on the downside. And we want to make sure that we have that consistent return overall over the long term. Now, seeing consistent performance consistent performance across this page is perhaps more important for the long-term growth than swinging wildly. And so there are times that these 70-30 benchmarks, these other bars that we're showing, substantially outperform and substantially underperform. But that's what the market is doing. What we're looking for those dark blue bars is to have relatively consistent performance overall. And we've seen that, as you see, over the past 22 years, an average annual return of about 6%, which really gets at accomplishing what we want here from the foundation's assets. Okay, so what about the future? I love this idea of there are facts, possibilities, and probabilities. This question up at the top is, where are we in the economic cycle? This is not facts. This is possibilities and probabilities, very much so. And this gets into maybe thinking about the future a little bit. And then you could argue that where we are in this economic cycle for a portfolio that's intended to be around forever doesn't actually matter. But it does matter, I think, because we take the economic cycle into consideration when we're thinking about risks to the upside or risks to the downside. And that can really color what are we working on as the investment advisory committee, and how are we prioritizing our work this year versus any other particular year. So the circle that you see here is an economic cycle and a schematic. There's a lot of words on the right-hand side. Maybe just ignore that. They are color-coded to sort of indicate the degree of risk. Now, some of those are facts, but as we think about this economic cycle, again, starting at 12 o'clock and working our way clockwise here, in the upper right is quadrant 1, coming out of a recession. There's more upside risk, of course, because we've gone through a recession. And then as the economy matures, that shifts into quadrant 2 and the recovery strengthens. Quadrant 3 is where the pace of recovery slows. And then quadrant 4 is the recession. So if you've been paying attention to the headlines, or if you care about what economists think, you might actually think that the economy is somewhere between quadrant 3 and quadrant 4. I love, Diana, your chart that shows that essentially there is no consensus on this. We could actually see decent positive growth, decent negative growth, or awful negative growth for this next year. But in general, when we look at the facts that are on the right-hand side and we color code them to the risks, there are more downside risks than upside risks. And that colors a lot about how we want to prioritize our thinking and lean into certain priorities versus other priorities for the Investment Advisory Committee. And we'll get into that in just one moment. So this is the short term, more risks to the downside than the upside, perhaps. But to this modeling that, Diana, you mentioned, the long-term modeling that we do, we model this and remodel this for the long term every year with the Investment Advisory Committee, usually not to change anything, but just to reaffirm that we've got the right strategy. So there's a lot of numbers here. Let me just focus everyone on a few of them. At the very bottom of this chart is the weighted average expected long-term return of the foundation's long-term strategy, and that's 6.5%. That's really decent when we think about it. We don't want to necessarily push for high returns, but when you think about the different returns that you saw on the performance page, okay, the 1 year was strong at over 10%, but as you look a little bit longer term, they are in that 5, 6, 7, 8% sort of range. That's what we're looking to achieve here. And given what we're projecting for different markets over the next 20 years, that 6.5 makes a lot of sense. But long-term strategy here, there's another component. In the middle of this chart, there's 3 numbers that are in this I suppose, dark blue or lighter blue box. Those are private investments. So that's the private equity, private debt, private real estate. And if you remember back to that asset allocation page, those are the areas of the portfolio that we're working very closely with the Investment Advisory Committee to deliberately, slowly, but deliberately allocate increasing amounts to. And the reason isn't to capture the return in the next year or the next market cycle. It's really the next 20 years, the long-term returns are expected to be higher in these asset classes. So that's going to really boost the long-term prospects for the overall foundation. Now, I do see some questions in the Q&A, or in the chat as well. Let me actually address those perhaps at the end, but just a reminder, feel free to keep those coming, please. I really appreciate them as we go along. As we look ahead toward the work in 2024 with the Investment Advisory Committee, there are a few themes that we use, and they're summarized up at the top. Adapting to an environment of inflation that's higher than we've experienced in the past decade. So thinking about real assets and things that are inflation sensitive and can help protect us when we have higher than historical inflation. Secondly, driving long-term performance across short-term instability. So there are more risks to the downside. How is our downside structured? How is our downside protection structured? And do we have enough of that? How do we want to actually manage that? Third, there, assessing exposure in new and emerging areas. You can read that in many different ways. There's, of course, emerging markets, which come with all sorts of issues, country by country. You can also read that as AI exposure or renewable power and the investment opportunities there. And so all of that is part of the work in thinking about the exposures in the portfolio. Fourth, sustainability, aligning the values. I'd actually say that this foundation has done a terrific job of aligning with Jewish values, with a dedicated and substantial allocation to Israel and other places that really align with the overall mission of the foundation. And finally, governance, the key to agility here. Are we making the right decisions with the right sort of frequency? Now, this is all concept, and perhaps to bring it home with one last slide, which are the priorities for the Investment Advisory Committee for 2024. Before we get into Q&A here, there are three, and this is not to say these are the only three things that the Investment Advisory Committee works on. There's actually a laundry list of things that every single quarter we go through, but if we're going to lean into certain things, number one, continuing to examine the right allocation of stocks, which has a target allocation of 40% across the total portfolio, so it's the biggest piece. And how is that allocated around the world? How much should continue to be allocated into Canada? What about the US when markets are frothy and it's an election year in the US? What about emerging markets? What about China? Revisiting all of that part of the foundation strategy has already begun. That began with a recent meeting late in 2023. That work is going to continue here as we move into 2024. So second, portfolio defense. If we're seeing more downside risks than upside risk, is our downside protection structured appropriately? The last time we really examined this part of the strategy, interest rates were half or less than half of where they are today, or closer to 1 to 2% as opposed to 4 or 5% today. So what does that mean for the right strategy going forward? And this is going to be the important work over the next 2 quarters. Finally, number 3, asset allocation transition. This is that continued move from public into private markets. That's ongoing work. For those of you that have joined these webinars for a few years, you'll note that that has been a priority now for a few years. It continues to be the priority here, and we'll continue to focus on this until we get that allocation of private markets up to that target of 25%. Okay. I think that actually does it for the prepared remarks here. This is just a reminder to use the Q&A button to type your question in for any of us here on the call. If we don't get to answer your question live, the foundation team will follow up with you afterward. You can also email the foundation at jewishfoundation@ujafed.org. I'm going to leave this slide up for just a minute or two. So for those of you that might want to write that email address down, you have a chance to do that. But then as we start to answer questions, I'll stop sharing screen so we can see more of each other. So, okay, on to the questions. I actually think that there's one that's come in from the Q&A here, which is on that performance chart. How do we compare to relevant benchmarks? I think we showed relative to a 70-30 benchmark, which are relatively simple benchmarks that were performing in line. What really important is what Diana mentioned, risk-adjusted return. We look at performance relative to a series of benchmarks that look at added value, and the performance of the portfolio is in excess of all of those benchmarks. And particularly on a risk-adjusted basis, that risk of the portfolio is substantially lower than the risk of the benchmarks. And so to have achieved outperformance with that lower risk return profile, we're really, really proud of. Okay, I see a few other questions here, and they're in the Q&A as well as in the chat. So maybe I'm going to start to address a couple of them Diana, I actually might throw it to you in a moment about ESG policy or allocation. But the first question is, why do we invest so much in illiquid private assets when the primary purpose of the portfolio is to distribute out to the community? The portfolio has a purpose to distribute out and support the community in perpetuity. And I think that time frame is what's really critical here. There is always this push-pull between current needs and protecting the portfolio for future needs that are anticipated in future generations. I'd actually argue that for those of you that know a lot about foundation portfolios, a 25% allocation to private assets is modest. It's not super low. But when we're talking about, say, a university foundation or other institutions that take in a lot of assets and also have an in perpetuity timeframe, those allocations to private assets can be 40, 50%. So 25 is on the modest side to help recognize that long-term orientation, but that there are immediate needs that need to go out in the community, and that liquidity is structured there. Couple of other questions. Diana, I don't know if you want to take this one or I can answer it. Does the foundation have an ESG policy or allocation?
I'm sure, I'd be happy to. We do have an ESG policy. It's outlined, and you can receive it if you like to see it. I would just explain the spirit of our ESG policy. So first of all, of course, the obvious, anything that's anti-Israel, anti-Jewish, anything that is not good for us will not be invested in. In terms of what ESG means to us, we do look just to make sure that companies or asset managers do take it into consideration. So ESG is just good business practices. It doesn't mean that we're going to be not investing in, say, you view oil companies as something that is not ESG or climate, but we do encourage and look at ESG score ratings, which Mercer does have when they do their due diligence on the managers. And when comparing one manager to the other, all else equal, a higher ESG score will get you our money versus not. But there is no restriction per se. All of our investments, and Texas, correct me if I'm wrong, all of our managers have pretty high ESG scores, which means that they do incorporate governance metrics into their fundamental analysis of the companies they invest in. There was one time, this was in the beginning of my time with a committee before I was chair, there was one manager that had a company that was anti-Israel, and I think we actually connected there and took some funds out. That is kind of the spirit of our ESG policy. I hope I answered the question.
Yeah, I think that's wonderful. Thanks, Diana. And I will say now, sort of related to a values-aligned portfolio is another question that's come in, which is, do we have investments in Israel in any way, and are we looking to increase that with recent events? So I will say that those of you that know the investment policy may have noticed, and maybe if you don't know the policy and you may not want to read the whole thing, there is a component of the policy that talks about values alignment and actually talks about a minimum allocation to Israel. And that is 3 times Israel's weight in the global market capitalization, which is relatively modest, but the idea is because it is modest, we want that minimum allocation to be 3 times that. That's a mix of Israel bonds and Israel stocks. We are continuing in this move into private investments to look at Israel funds on the private side, whether they're venture capital or other types of private funds that there can be in Israel. And I will say that our team at Mercer actually supports quite a large number of Jewish foundations and federations across the US and Canada. And we've looked at about a dozen support investments, essentially, because of what's going on in Israel. And some of our clients have made allocations to some of those. So some of those are providing us, for example, bridge financing to Israel companies that are venture backed, but that are seeing disruptions because the entirety team of the team for some companies is being called to military service. So those sorts of things are things that we're continuing to look at, and we will continue to look at. But by policy, there is a minimum allocation to Israel in the overall portfolio. Related to this is examples of companies that have been removed from the portfolio or screened out. And I think that's a question that's come in through the chat. And I will say what we do less on the specific individual screening and more in advocacy with investment managers to point out to the managers that this is a Jewish foundation. We have Jewish values. This is what we expect. We also have an anti-BDS statement in the investment policy that would communicate to the investment managers. So investment managers know that they may not invest in companies that are actively involved in the BDS movement, which for those of you familiar with it, you know what it means. But for those of you that are not, is essentially an anti-Israel advocacy campaign with companies, and that won't fly here. A couple of other questions coming through. There's one really good one, which is Mercer's long-term investment target of 6.5 seems to fall short of the foundation's policy, which is distributions plus inflation. You add that all up, that's closer to 7.5. Really good observation. I skipped over some of the words on the right-hand side of that page, and those words pointed out that 6.5 is what we expect from the markets. And then there's the additional work to look for alpha or outperformance of the markets. And historically, that alpha has been between 50 and 100 basis points per year. That is directly the added value of the work of the Investment Advisory Committee to do all that work, to set the strategy. That means markets are going to give us a certain amount, and then do work to outperform that. So that is how we expect to be able to outperform that. Now, it will be easier as interest rates are higher to be able to meet that just because we have a distribution policy rate that is closer to 5%. And so when interest rates were at 1 or 0, that was hard to make up with just bonds. Now that rates are 4 or 5, that's a whole lot easier. But that still means we need to actually keep pushing for higher returns. I don't see any other. There is a question about risk or standard deviation of the portfolio at year end. I don't have the precise number here. I know that when we looked at it for that chart on performance, whatever the standard deviation or volatility of Canadian stocks were, take 46% of that, and that is what the volatility was for the portfolio over the last 5 years. I think we can follow up with those specific statistics to the person who asked that question overall. I'm looking here to the fellow panelists. I do not see any other questions. Are there any others that folks see? Maybe I'm missing something here. All right, well, we're about 5 minutes before the end here. We did want to end perhaps a little bit early. And I think that may, if there are further questions, of course, please email the Jewish Foundation email address here. Let me put that back up on the screen and then turn it over back to Diana to close us out. And if you'll give me one moment to share my screen. Again, at the bottom of the page, jewishfoundation@ujfed.org. Thank you all. Diana, I think you have some closing comments here.
Well, it's like I said in the beginning, these are very challenging time for our community. What Sarah Lefton said in the beginning of our presentation, the incredible amount of generosity that this community has shown and been able to deliver to both here and in Israel has been absolutely incredible, and I'm personally very honored to do this work. I want to thank everyone for joining us. Texas, thank you so much for all the work that you do for us, and to all of you that have joined this presentation, thank you for all you do for us.